of course, a bold prediction has been made by Infosys co-founder Nandan Nilekani. He has stated at an event that was held recently that India could have 1 million startups by 2035, with most of them emerging from non-metro cities. Currently, India is home to around 150,000 startups, which are growing at an impressive annual rate of 20%. Now, Nilekani attributed this growth to a unique phenomena, which he called as binary fission, where successful startups inspire the creation of new ventures. He also pointed out that these startups are increasingly focused on solving region-specific challenges, specifically in smaller towns or cities. Highlighting the role of technology, Nilekani also emphasized the potential of AI in driving this growth. He advocated for AI solutions that are tailored to India's diverse languages and suggesting that embracing this technology can significantly boost the startup ecosystem and fuel the country's economic progress. Remember, ladies and gentlemen, this is being talked about quite very many times, but it becomes all the more significant when somebody like Nandan Nilekani speaks about the startup progress, the startup culture that is coming up in India's smaller towns and cities. But shifting away a bit from the startup ecosystem, let's put the spotlight then on IT sector, which continues to be under pressure amidst Trump's tariff anticipation and worries regarding a perceived recession in the United States. Will the companies report a subdued Q4, or the robust deal and order pipeline continue to boost their revenues? While Gaurav Javalkar, my colleague, is here with more details. In fact, brokerages are also commenting on India's IT sector growth. Let's get in my colleague, not Gaurav, but Ansh is joining us. Ansh, what do the brokerages say?
Well, as per report from Nuvama and Morgan Stanley, outlook for Q4 is a bit mixed, driven by uncertain macro conditions and softer seasonality due to weaker macro factors and some AI-driven deflation. If we talk about large-cap IT companies, then like TCS, Infosys, Wipro, HCL Tech and Tech Mahindra may see sequential revenue decline. Whereas if we talk about mid-cap IT stocks like L&T Tech, Coforge, Persistent and Emphasis, they are likely to report a positive growth from 0 to 4% on a sequential basis. Also, if you talk about cross-currency headwinds, then that would be around 60 to 100 basis point, which could even dampen the reported revenue, which is a negative sign. Also, despite challenges, deal flow are expected to remain strong, whereas margin should stable with slight improvement, but the focus will be on FY26 guidance, expected to be a modest year. If we talk about Nuvama highlights, then we are seeing that they have highlighted that IT stocks have seen a sharp correction in last 3 months, and this is due to macro concerns. While Morgan Stanley's top pick for structural growth are Coforge, Persistent, Infosys, KPIT Tech, LTIMindtree and Sagility. Interestingly, whether or not US enters into recession, Indian IT could still benefit either from digital transformation or cost-cutting initiative. So all eyes would be on company guidance to see whether they navigate these challenges.
All right. Thank you very much, Ansh, for bringing us a snapshot of what the brokerage is saying about India's IT sector growth. Of course, there's going to be some softness owing to macroeconomic headwinds, particularly related to geopolitics, but the sector could still have a strong set of growth coming in. In fact, Crisil has also come out with a report that states that the sector will continue to log mid-single-digit growth for the third consecutive fiscal amidst continuing macroeconomic headwinds in Europe and the United States. And of course, ladies and gentlemen, to throw more light on the larger impact on the industry and hiring trends that we're going to be seeing in the coming few months, we're now joined by Anuj Sethi. He's a senior director at Crisil Ratings. Thank you very much, Anuj, for joining us here on ET Now.
Good evening. Thank you for having me.
Right. Anuj, so this is, according to what Crisil's report states, that this is going to be the third consecutive fiscal of mid-single-digit growth for the industry. What do you think are going to be some of the biggest challenges besides Trump's tariff-related policies? And what is an overall impact that you see for the sector in this fiscal? If you could speak quarter by quarter.
Sure. I'll give you a overall ballpark figure. While we did see some green shoots emerging, in the second half of the last fiscal, I think that the tariffs which were announced for some of the industries, I think that has muddled the forecast a bit. But we are still holding on to our overall forecast of about 6 to 8% for fiscal 2026. But if we remove the forex impact or the benefit of the rupee depreciation, our forecast would remain about 4 to 6%, which is again similar to what you were just speaking about the growth in some of the companies which we are expected to see in the quarter which is just gone by. I think what is happening is the largest segment, which is BFSI, there we were expecting a good amount of deals to start flowing in. But given that this is also dependent on discretionary spend, we could see more of focus on AI and Gen AI rather than enhancing the quantum of BFSI spend. Uh, Other sector which we are expecting will do slightly better segment will be the healthcare segment within the overall IT software space. Uh, I think that is a segment which is continuing doing well even in the past couple of years, and we are expecting that will be one of the segments which will grow faster than the 4 to 6% overall. Uh, what we are looking at growing. Manufacturing and retail, on the other hand, we're expecting a sort of flattish growth, and that is largely in line with what is happening, in the US as well as in Europe, uh, where manufacturing and retail both are going through some amount of difficulties.
Right.
Yeah.
Right. Anuj, so when you speak sector by sector, when you speak in terms of sector specific impact, you said that BFSI is going to face some volatility. There's going to be some impact on BFSI, and there's going to be flattish growth, which will come in from manufacturing and retail. Could you help us understand why that is going to be the case, and why softness in these two sectors that you particularly spoke about is going to be there?
Yeah. See, manufacturing will definitely see some impact because of the sluggishness which we are seeing in the US as well as European economies. And these two geographies are the biggest contributor of Indian software sector revenues. Uh, and with the tariffs coming in, it could lead to higher inflation in terms of the cost for the manufacturing sector as well in the US. Retail sector, went through rapid expansion, and we saw a lot of growth happening immediately post COVID. But that has stuttered, in the last couple of years, uh, and we've seen a number of store closures also happening, large chains shutting down in the US, and that is something which is continuing even in the current fiscal. So that has really impacted, retail growth. And manufacturing is something which I covered earlier. The tariffs will only slow down the growth further in the manufacturing sector in the US.
Right. Right, Anuj, but before Donald Trump became president of the United States, before he won that election, was Crisil or, many other brokerage firms, were you factoring in this kind of slowness? And how much of this volatility, how much of this softness in the IT sector is being driven by Trump's policies? If you could throw some light on that as well.
Maybe 100 to 200 bips more in terms of the growth rate, not more than that. We were not expecting it to grow back to the double digits either, because, like I said, while BFSI was expected to see some fillip, the other segments were expected to remain somewhat muted, except healthcare, even with or without the current dispensation which is there.
All right. So you were factoring this in, but when do you think the sector will be able to grow back to double-digit growth?
I think a lot will depend on when the largest segment, which is BFSI, really sees some amount of significant investment going in. We expect maybe a couple of years down the line, at least. I think that's what should take it back. That will inch the overall growth closer to double digits, is what we believe.
All right. So amidst this volatility, Anuj, how will deal flows look like? Will it be multiple small deals that will be signed, or there will be like one big deal? That's what essentially what we've seen with some IT companies in the past.
See, we are seeing a combination of both happening at the moment. The smaller deals are happening more where AI is the focus, uh, whereas the larger deals are happening because of vendor consolidation also, which is going on. At the customer's end. I think number of vendors, which used to be 3 or 4 earlier, they're being reduced now to one or two. So we are having some large deals coming in as well, and that is something which we are also seeing in Europe. Uh, uh, but otherwise, in the banking and financial services space, it is largely, and even in the manufacturing space, it is largely the mid-sized deals which are happening.
All right, so mid-sized deals, and of course, like you earlier stated as well, Anuj, it's the manufacturing, retail, and BFSI segment which are particularly of concern. But let's talk about the point that you raised about AI, because there's also AI-related churn which is expected to happen. But how severe will that be going forward, combined with these several headwinds that we're seeing?
Right. So we hear from players about deal wins around AI and related aspects like Gen AI. However, these AI-based offerings are bundled with traditional sources, making it more efficient for end users across various business segments. For example, in the BFSI space, deals are largely around automation, digitalization, and embedding AI and Gen AI use cases in existing banking platforms itself. Whereas in the retail segments, companies are more focusing on
All right.
availing data insights and using AI tools to gain insights into customer behavior and optimize their offerings and strategies accordingly.
Okay.
In the healthcare segments, we are seeing investments
All
happening
right.
towards
All
improving
right.
customer offerings, curated treatments, etc., using AI.
All right, Anuj. Let me also ask you about hiring trends. All that you've spoken about, the softness in IT, particularly in BFSI, manufacturing, retail, the macroeconomic headwinds that are going to have an impact on the overall growth of the IT sector, single-digit growth. How will that translate into hiring for this FY, this financial year, considering that there is some caution, particularly on that front? It's being maintained since past many months as well. And what is your view, particularly on entry-level jobs for the sector?
Yeah. We believe that similar trends, what we saw in fiscal 2025, will pan out in 2026 also with respect to hiring, especially at the entry level. I think the excess bench strength which is there, I think that has been curtailed in the last fiscal. We expect IT companies will focus on employee utilization at levels of, say, 85 to 86%, which is almost the peak, I would say. And other thing is, the attrition levels also in the industry have dropped significantly. We did see attrition levels inching up to almost 25, 26%, immediately after the pandemic, the year after the pandemic. That has almost fallen by half. So it is hovering around 12, 13% now. So that is another reason why also the hiring, is somewhat muted.
And hiring will remain muted is the indication that you're giving. And of course, these are some of the trends and stories that we will be closely following. Thank you very much on that note, Anuj, for joining us here on ET Now and sharing your thoughts and perspectives on what some macroeconomic headwinds that we're seeing, geopolitical headwinds as well that we're seeing are going to mean for the overall IT sector. Thanks very much once again for joining us. And ladies and gentlemen, time now for us to slip into a very short break. But be right back. We have lots more coming up on the other side.